close to targets then, we were hearing from Fisher. A little bit of a divergence then at the Fed, do we see, between Janet Yellen and Fisher, and how high pressure, how hot they think it's appropriate to run the US economy?
Well, yes, I think we are at a kind of crucial juncture here at the Fed. We've seen in the last meeting and also in the minutes that there is a hot debate going on. I think the key, discussion point at the moment is more on the unemployment side, actually. So is unemployment really the best measure of the best gauge of slack in the economy, and people increasingly pointing to that increase in the participation rate. So people who weren't at all in that unemployment figure now returning to the labor market, meaning that there's perhaps more slack and that wage growth won't pick up, and therefore inflation won't pick up more either. And that means, even though you may be raising rates in the short term, you will do that at a very, very, very slow pace, much slower than the dots, for instance, in the Fed's chart would imply.
He, of course, went on in that discussion to talk about the four factors that are holding the American economy back. And I think we've got those on a chart for you: low productivity, demographics, along with a number of other facets. I mean, we're splitting hairs now at the Fed. Isn't that a fair statement, in that he would argue that we're really arguing over nths of a percent in terms of unemployment? And he also mentions that the Fed doesn't have to be the only game in town.
Well, and I think that's something that we see globally. Monetary policy is, of course, to steer the short-term, economy and towards the inflation target can be very powerful and has been very powerful. In some cases, it may be reaching its limits, but it has been very powerful. But there's also a big role to play for governments, and not just in the short-term stabilization sense, fiscal expansions or restrictions depending on where the economy is, but also over the longer term, the structural reforms that we've, in Europe, we've been talking about for ages, but in the US, they are also necessary. And these points, these four factors, are essentially all points that the government needs to address in terms of structural reforms. And we now have elections. There will be some outcome, and hopefully the next administration will do even more than the previous one.
Well, yes, some people are asking questions about whether many are asking, depending on the results, of course, of the election, not just the presidential election, but what this does to the House, whether we might actually see a government that is able, for better or worse, to act more than this last administration. And what would you suggest they need to do then, Christian, or what would your colleagues at Citigroup suggest they need to do to improve the prospects of the US economy?
I think that the main thing is the entitlement reform. That's been pushed out. Back in 2011, when we had the big debates about the debt ceiling, and there were signs that maybe that could be a fix for these longer-term entitlement for pension reforms and so on. That was eventually then pushed out into the future. It hasn't been done since. A sweep of either side, whether it's Democrats or Republicans, could really open up the way for such reforms. However, a sweep either way still looks like an unlikely result. So it is actually quite possible that, with some tinkering around the edges, we won't get that fundamental reform that would be necessary.
Christian, we started this show talking about 30-year government bond yields in the US getting drubbed. But what we've got for our viewers here is, bottom of the screen, hashtag 4170. This is the global family of negative yielding debt, and it's dropped by 13% in September. Now, what does that say to you? Does that say to you that the world or the bond markets are perhaps concerned about inflation, or perhaps concerned about central banks' commitments?
Well, you've got these ominous potentially hawkish signs out of various places. The Japanese, going for yield targeting rather than purchasing assets at a certain amount every month or every year. In Europe, we've got this talk about tapering as well. The Fed may be hiking rates again in December. Inflation is on an uptrend, not so much because fundamentally or sort of the underlying inflationary pressures are getting stronger, but because oil effects are dropping out and now oil is also rising. So it feels like, generally the trend is towards higher yields, higher central bank rates, and that may be one of the reflections. But we have to keep in mind that because there are no big underlying inflationary pressures, that move of central banks is going to be slow. If it leads to any kind of recession, and there's many reasons to believe that there could be recessions on the horizon, then clearly central banks would once again very quickly step on the pedal again, and then this chart may very quickly go the other way again.
That sounds a little ominous, Christian, the talk of recessions. But
the R word, yeah.
Yeah, looking at the oil price, it's around 50. It's been around 50 for a couple of weeks. This seems enough to just put a little bit more inflation back into the system, as we've seen, as we've been talking about this decline in the negative yielding club, in part driven by inflation expectations and the oil price being higher. But it's not high enough, is it, to trigger us into that kind of recession environment you're talking about, or is it? Is that why you're nervous about recession?
Well, it's more, I mean, the oil price, unless it were to really spike, I don't think is necessarily the reason for recession. In fact, if it were to drop again and we'd have emerging markets in trouble and global trade again in trouble, that'd probably be a bigger risk for recession than a higher oil price. But there's so many mainly political risks actually out there, the US election being one of them. In Europe, we've got referendums and elections out there, all of which can spring a very negative surprise and throw us back into trouble.